Good afternoon, everyone. Welcome to the Tax Resolution Help Center. My name is May. I will be hosting today's session and introducing today's speaker. I will also be coordinating the chat session, the Q&A chat session at the end of this session. I want to congratulate all of you for taking steps to deal with your taxes. Taxes from all sources, including income tax, payroll tax, property tax, excise tax, and sales tax, represent a 35% to 60% reduction in your personal savings and wealth. As you probably know, those with 1% of the wealth in this country have experts to help them pay a small percent of tax. Our goal is to help you reduce how much you pay in tax by educating and informing you on ways to reduce past, present, and future tax expenses. We think you are entitled to live a happier, healthier life by keeping more of what you earn and getting the taxman off your back. Our goal is to provide you good information with the opportunity to ask questions that are important to you. The presentation itself will last about 20 minutes plus 20 to 30 minutes for you to ask questions by chat. I will select the questions and present them to today's expert. If you wish, you can include your first name and your state. That would be great. Other than that information, your identity is not mentioned. The information you are receiving in this session is not specific tax advice. If you want specific tax advice for your situation, you are free to contact today's expert or any of our tax experts at Tax Resolution Help Center. As you know, these group sessions are included in your do it yourself membership fee of $20 per month. If you are not yet a member, please sign up today. We need your financial support. And to better understand what might be on your mind during the session, I might include some pooling questions to ask you. I will then finish with a 5-minute wrap up. Also, a survey will be sent looking for your feedback. And finally, this session will be recorded. The topic for today's session is filing your tax return, dealing with rental properties and Schedule E. The tax expert for today's session is John Shantz. John has the unique perspective of being both a business advisor and business owner. His wide ranging experience can help business owners and employees get through everyone's least favorite topic tax compliance or the repercussions of non compliance. With that said, introducing John Schatz.
Thank you, May, and thank you to everybody who is here today. My pleasure to be with you. So today we're talking about dealing with rental properties and Schedule E. A little bit about me before we get into that. Again, my name is John Shantz, and my contact information is right there. If after this session you have questions that aren't answered and or need further clarification on any questions I did take or answer, please feel free to contact me. I'm here to help you to the best of my ability, and been doing this for many, many years. Spent 10 years in public accounting early in my career, and then spent almost 30 years running a home building land development company. And now I'm back just focusing on accounting, consulting, and tax work. And while I'm always open to getting some more business, I'd really love to help you avoid any mistakes or problems you might have. So if we can have a simple discussion after this, feel free to give me a call. When I'm not having fun working, I'd rather be skiing. So some of the objectives today and things we're going to cover, we're going to talk about rental real estate. What is Schedule E? We'll talk about basis or the cost of your property, depreciation, capital improvements, repairs and maintenance, and we'll touch on the passive loss rules that apply to real estate. So rental real estate, why own real estate? If you're involved in rental real estate, you may very well know this, but you can get some great leverage on your investment. You can put down $20,000 and take out a $200,000 mortgage and control an asset that's worth $220,000. Leverage can be great until it isn't. When people get into trouble with rental real estate, it usually involves over leverage. One thing to think about long term when it comes to rental real estate is having cash available to get past any downturns in the market. So if you have a rental property, just like the last couple of years of COVID, a lot of people who had Airbnbs and VRBOs all of a sudden found out they didn't have people coming in to rent their property, and yet they still had to carry a mortgage. So you always have to be a little bit leery, a little bit conservative to have cash available so you can float that property if we run into difficult times. And then one of the other great things about rental real estate is cash flow versus taxable income. Rental properties generally tend to throw off taxable losses while generating cash flow. So you get some expenses or deductions on your tax return while still putting cash in your pocket over time. Types of rental properties, you run into house hacking, when a lot of young people like to go out there, buy their first home and rent. Maybe they get a duplex and rent out one half of it and live in the other half of it. You have vacation homes, vacation properties such as Airbnb or VRBO properties. And then you also have commercial rental property, and that's a whole nother animal altogether. So let's get into some of the details here about Schedule E. Schedule E is a form with your 1040. 1040 is the individual tax return that most people file. And Schedule E is used to report the income or loss from rental real estate and some other items. We're not going to get into it. I just noted that here just to be kind of full disclosure. And Schedule E is more than just rental property. Some key information on your Schedule E, and we'll just take a look right at the form itself. Is you have some information on here as whether you made payments to anybody you need to send 1099s to. So if you're hiring contractors or individuals to do work for you, you may have requirements to provide them with 1099s. If you answer yes to this question, the IRS is going to look for whether you filed 1099s. The type of property that you might have. And again, there's just a list of types of property: single family, multifamily, vacation, commercial, land, royalties. Need to enter that there. Then IRS also wants to know about the fair rental days. And fair rental days means the number of days rented at fair market value. The requirement is you rent the property at fair market value. And what taxing authorities are trying to get at there is avoiding deals where maybe you buy a property and let a family member rent it for below fair market value. So someone can get in cheap and you can get a bigger tax write-off. So the IRS wants to avoid that. You need to rent it at fair rental value. And then also personal use days, how many days you use it personally, because that's going to limit some of the deductions you might be able to take. And then whether it's a qualified joint venture might be if you have a husband and wife, own the property, and what has to happen there is you split the property into, you might have two Schedule E's on your return, one for the husband, one for the wife. So the other information that goes on the Schedule E, kind of the meat of it here, is your rents received. Rents is going to be everything you took in, and then the expenses associated with that property. Some of the big things most people have might be management fees, property taxes, interest on the mortgage, and then the last thing is depreciation. We'll talk more about depreciation, but depreciation is where you can get the tax write-off, but that's not a cash flow item. So when you get into Schedule E and your rental property, what you're trying to do is keep your income as low as possible, maybe bumping up the losses. And so you want to be sure that you're capturing all the expenses associated with that rental property. Make sure you're taking the deductions that you are entitled to and allowed to take. So basis. Why do we care about basis? Basis is going to factor into depreciation. Basis is the amount of investment in your property for tax purpose. Generally, that's going to be the cost of the property, what you paid for it. Property is listed for $200,000. You paid $200,000 for it. You may have some other expenses associated with that purchase that need to be added to that cost. Settlement costs. Maybe you had some legal fees associated with the purchase. If you had surveys and things like that, that might be added into the cost basis. But the biggest part of your cost basis is the actual purchase price of the property normally. Then you get into adjusted basis. The adjusted basis of the property is the cost plus improvements. Buy the property, maybe you rehab it. All those rehab costs are going to go into the cost basis. And then that total cost gets depreciated over time. So the adjusted basis is the cost of the property plus your improvements minus the accumulated depreciation. Some assets, your basis might not be determined by cost. Maybe you inherited the property or received it as a gift. That's going to get into some different rules. I'm not going to go into that right now, but just keep in mind that if you receive a property without paying for it, there's going to be some different ways of calculating that basis. And then lastly, you need to determine the cost of the land associated with the property you bought versus the building itself. So in my example before, if you paid, let's say $220,000 for a piece of property, you can't depreciate land. So you need to break out that cost. That cost can be determined. Well, there's a number of ways. A lot of times property tax records might tell you what the cost of the land could be. Obviously, if you built a building, bought a piece of land and put a building on it, you're going to know exactly what the cost of the land is versus the building. We care about cost basis because cost basis is where we calculate depreciation from. Residential properties generally depreciated over 27 and a half years. And again, land cannot be depreciated. One of the biggest things I see when it comes to tax work and rental real estate is confusion about taking depreciation. Plenty of people forget to depreciate the property. They didn't know about it. Maybe they hired someone in the past to do their tax work and no depreciation was taken. It's really important that you do take the depreciation that you're entitled to. One, you spent the money on the property. You want to take the deduction that you're entitled to. Second thing is, if you don't take that depreciation and you go and sell the property 10, 15, 20 years down the road, IRS looks at your return and says, hey, there's no depreciation on this property. They're going to come in and say, well, you should have taken it. You're allowed to take it. You have to take it for purposes of computing the gain or loss. What that really means is the IRS is going to give you a bigger gain and you lost the benefit of getting those deductions over the years that you own the property. So that's kind of a lose-lose situation. That's why I say it's really important. Take a look at depreciation, make sure you're doing it right, make sure you're getting the deduction you're entitled to. If you discover, hey, I forgot to do this, I wasn't doing it right, there are ways to fix that. You can file a 1040X, which is an amended tax return that allows you to go back 3 years, and you would file for a change in accounting method as well. The details of that, a little beyond the scope of this discussion right here, but keep that in mind. And if that's a situation you have, it's probably worth having, a professional look at it and help you make those adjustments and fix it up. So keep that in mind. And then when we get into depreciation, I got a lot written here. I'm not going to go say everything that's here, but the other big area that people wonder about is capital improvements versus repairs and maintenance. Capital improvements, like we just talked about, that goes into the cost of the building. You might rehab the property. The expenses you rehab the property, rebuilding it, putting an addition on the property, that's going to be capitalized and depreciated over a period of time versus repairs and maintenance. Fixing normal wear and tear, you get a write-off immediately in the year that you paid for those expenses. Fixing a leak in a roof, that's a repair and maintenance. Doing a complete tear off and putting a new roof on, that's something that would be capitalized. Another big one is painting. Painting is usually repairs and maintenance, pretty much all the time. Normal repairs and maintenance. Now, if you paint the house as part of rehabbing it, that's going to go into the cost of the property. So you're just going to want to keep that in mind. Make sure you can get if you can get the write-off immediately, go and get the write-off immediately. But if you got to capitalize it, make sure it gets capitalized and written off. Income and expenses. So we touched on that real briefly when we looked at Schedule E. Keep good records so you can figure out what actual expenses you had and get the deductions you're entitled to. I usually recommend to people the easiest way to make sure you keep track of your income and expenses, just have a separate bank account for that rental property. It'll make it real easy for you at the end of the year to kind of get everything in shape. If you lost receipts or something like that, hey, at least you got it in your bank account and you can kind of recreate what you spent money on rather than commingling it with your personal expenses. And for people who aren't doing their own bookkeeping, or if you're not going to do bookkeeping, again, separate bank account kind of makes that easy to put back together at the end of the year and figure things out so you can do your tax return correctly. One quick note here, advance rent is recorded in the year received. Security deposits, something you might have to return to somebody you're leasing the property to, that's not going to be income. That's something you can set aside and don't have to worry about it. Now, in the year someone leaves a lease, if you keep their security deposit, then that's going to be income. And then lastly, when you get into duplexes or multifamily type situations, if you're living in the property, you're going to need to take into account the allocation of costs, splitting costs between your property and the property you might be renting out. Passive loss rules, touch on this real briefly here. Rental income or loss is generally considered a passive activity. This has been around for quite a few years. The big deal with passive losses is they are generally not deductible unless you have modified adjusted gross income of $100,000 or less. Your adjusted gross income for most people is going to be W-2 wages. If you're self-employed and maybe have a Schedule C business, sole proprietorship, that's going to be generally your adjusted gross income. So if your income is between $100,000 and $150,000, there's going to be a phase out of this $25,000 passive loss you can deduct. So if your income is under $100,000, you get to deduct up to $25,000 in passive losses. After that, you might be limited. And again, the nice thing about that is you get to write that loss off against your regular income and reduce your personal income taxes. Quick summary of other issues you might get involved with. active versus material participation, whether you're a real estate professional. When you go to sell the property, you need to make sure you have kept good records of your depreciation over the years, because that capital gain, if there is one, gets taxed a little bit differently than some other capital gains. If you had any bonus depreciation, Section 179 property, I'm throwing some terms at you, maybe I shouldn't, but there may be some other issues you have to deal with depreciation recapture. If you own the property as an LLC with partners, you might have some other issues to deal with as far as filing potentially separate business tax returns versus putting it right on your own tax return. You have at-risk rules that might come into play there, and that really involves taking out loans, and whether you are responsible for the loan or somebody else is. You can't deduct losses when you're not at risk. Home office, business use of auto might be an area where you can find additional expenses to write off against your rental income. Personal use rules, I mentioned that before. If you're using that property personally as well as renting, there's some different issues you're going to have to think about. And then if you have enough rental income, you might be subject to a net investment income tax. So that's a kind of a quick summary of everything involving rental real estate. There's obviously more that goes along there. The big takeaways: try to keep good records. Again, the best way to keep good records: separate bank account, depreciation, capital improvements versus repairs and maintenance are some of the biggest issues we see out there. And so that's a quick summary for rental real estate. And if you have any questions, go ahead. Let's see what you have.
All right. Well, thank you for that, John. We do have a question here. One of our attendees. This is from Alex, and his question is: I want to do an Airbnb rental. Do I have to depreciate this? I have heard there is some recapture of depreciation if I sell the property. Not sure if I want to do that though.
Sure, Alex. Good question. I kind of touched on that before, but if you have a rental property, you are required to take depreciation. You're entitled to take depreciation. If you don't take depreciation, in theory or in reality, you're still going to have that depreciation recapture when you go to sell the property. And again, recapture isn't necessarily a bad thing. It just means that to the extent your gain is equal to the depreciation that was taken, it's a slightly higher capital gains tax rate, potentially higher capital gains tax rate than the 15 or 20% normal maximum. So it's not a huge thing for most people. It's something that's there, but if you don't take that depreciation while you own the property, you're still subject to that recapture. And as I mentioned earlier, that's a lose-lose. You didn't get the expense while you owned and operated the property, and then they still have to do the depreciation recapture. So I would advise you take the depreciation.
All right. Well, thank you for that, John. Second question. This is from our StreamYard, one of our viewers. He's asking if why does the loss on my rental no reduce my adjusted gross income and my taxes? Is it related to the materially participate question?
The main reason you're not getting the loss is probably because your adjusted gross income is too high. I mentioned earlier that you can deduct up to $25,000 of passive activity losses. So if your adjusted gross income is up above $150,000, you're not going to be able to take that $25,000 loss or up to $25,000 loss. And that's probably why you see it not reducing your income. Now, those losses aren't lost forever. they carry over. So if you come across a year where your adjusted gross income is low enough, you can take some losses, you can use it, you get to use it then. Or when you go to sell the property, those passive loss carryovers can reduce the taxable gain on the property. So it's going to just be a timing difference. If you aren't getting the allowable deduction every year, or you're not getting a deduction equal to the losses you have, so keep that in mind. They're not lost forever.
All right, great. Thank you very much for that answer, John. So that's it. That's the last question for today's session. Do you have anything else to say?
Um, no, I want to thank everybody for coming. Again, if the answer I provided, you still got questions about that, you're not 100% sure, please feel free to contact me. I'm not going to charge you for something like that. Love to help you out, and help you avoid any mistakes or errors down the road. So please feel free.
All right, that's so great to hear from you, John. Thank you so much for today's session. Truly appreciate your time and have a wonderful day ahead.
Thank you, May. Thanks to everybody too.
Bye bye. All right, that covers our questions for today's session, and I want to thank you for attending. Our commitment is to help you reduce your taxes and increase your wealth. We do this with a tri tax method of DIY, do it yourself, DIT, do it together, and DIA, do it all. Three methods, one solution. Reduce stress from no IRS or state tax debt and a happier, healthier life. If you are not yet a member, please join for less than $20 per month. We need your support to continue to offer more of these sessions. Since it is now tax season, we have many sessions to help you do a better job of doing your taxes yourself. And of course, if you want help, we have a team of experts who can do your tax return for you. Please check our website at taxresolutionhelpcenter.com. And please join as a member today for $19.95 per month. Thank you all for attending.